You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here with episode number 158 of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guests for this week's show are real estate experts and brothers, Andrew and Phillip Syrios. Now, our show with Andrew and Phillip is going to be somewhat unconventional today because we're going to be talking about single-family investing and why Andrew and Phillip chose to invest in single-family over multifamily or commercial. And if you guys have been listening in, if you know anything about me, then you know that I'm not a big fan of single-family investments, and I've owned hundreds of them, okay? But Andrew and Phillip, they take a larger scale approach to their investment philosophy, which I can respect, right? And so I thought it'd be great to have them on the show and share their story. So here's what you're going to learn in the show today with Andrew and Phillip. You're going to learn how they got their start in the real estate game and why they prefer single-family portfolios versus multifamily and commercial real estate. You'll learn what they love about investing in the Midwestern part of the country and why they decided to focus all their investment efforts there. You're going to learn about the power of building rapport with sellers and how it doesn't always come down to the highest offer, but rather the seller's personal feelings towards you. Rapport is king, guys, okay? It's very, very, very important. You're going to learn how to build a successful property management company versus outsourcing to a third-party management firm, like it's very common in this business, okay? Andrew and Phillip, they built their own management company, okay? And they're going to tell you why they did it. You're going to learn about the difference between a tenant in common, also known as a TIC, and a syndication arrangement. You're going to learn about the importance of completing a thorough walkthrough of each and every unit and how not doing this can burn you big time. Okay, this would be during due diligence, why it's so important to walk through each and every unit. You're going to learn about the dangers of underfunding capital improvements on the front end of a new acquisition and using the cash flow to supplement those improvements and why this is a big no-no. You're also going to learn about the secret to finding the best tenants, even in the less desirable areas of town, and much, much more. And guys, before we get on to the show here, I've got a few updates I want to run through with you guys. First and foremost, we just closed on our most recent acquisition, which is a 2-park mobile home package totaling 185 lots up in Salisbury, Maryland. In fact, I just released a video drive-through podcast, okay? This is the first time I've actually ever done a video podcast, but I just released a video drive-through podcast on our Mobile Home Park Investing podcast show that you need to go and check out, okay? I walk you through in detail the step-by-step process that we went through to purchase and how we're going to maximize the value of these 2 parks, okay? And the best part of this recent purchase is that the third-party bank appraisal that we got done for the financing came in at nearly $1 million higher than what we paid. Pretty exciting, right? Now, if you haven't done so already, go search my name in iTunes or search just the term Mobile Home Park Investing. You're going to find our Mobile Home Park Investing podcast, and you need to go listen to that because actually not listen to it, you need to watch it. Actually, we have an audio version and a video version, but the video version is the most beneficial because you're actually going to see me driving through the park talking about this recent acquisition, okay? So I'm positive that you're going to find a ton of value in this drive-through, and that kind of leads me on to my next point. My team and I, we're seeking out individuals to partner with us who have an interest in partnering with us on mobile home park opportunities, just like the deals here in Maryland. We have other deals in contract right now, and we are seeking accredited investors who are looking for higher than average returns on their money, who want to partner with a winning team. So if you have an interest in what we have to offer, you can go learn about our company, learn about our investment opportunity. You can even download our private placement memorandum over at sunrisecapitalinvestors.com. Again, that's sunrisecapitalinvestors.com. And lastly, guys, if you happen to be in the Tampa Bay area, I'd love to meet you. That's where I'm based out of, Clearwater, Florida. If you're coming to the area and you've got some free time, shoot me an email, kevin@kevinbupp.com. That's my personal email address. Again, kevin@kevinbupp.com. Just let me know when you're coming, and let's see if we can coordinate our schedules. I'd love to buy you a coffee, lunch, dinner, whatever you have time for, okay? So now let's get on to the part show that you guys have been waiting for, which is our interview with Andrew and Phillip. So here we go. Ladies and gentlemen, today on the show, we are thrilled to be joined by veteran real estate investors Andrew and Phillip Syrios. We actually had their father, Bill Syrios, on the show a few months back to discuss student housing. And if you haven't done so already, you can go check that out by going to episode number 120. Their father, Bill, is an incredibly smart guy, and I'm positive that you'll find huge value in our show together. So I guess you could kind of say that Andrew and Phillip were somewhat born into a life of real estate, as their father, Bill, had been at this investment thing for more than 26 years. But I don't want to discredit any of their successes because although they've had their father as a mentor, they really have paved their own path, and they've been absolutely kicking butt and taking names all along the way. And so in our conversation today, what we're going to do is we're going to kind of stray away from our usual topic of choice, which is commercial real estate investing, and we're going to dive into single family. Now, if you've been an avid listener to my show, then you'll know that I'm not a big fan of single family investments. Although I've owned hundreds in the past, it's not something that I invest in today. But our conversation today just won't be the typical buy and hold strategy or fix and flip. We'll actually be discussing single family portfolio acquisitions. Most recently, Andrew and Phillip have purchased two large portfolios, one with 41 homes and the other with 97. And in total, they've got more than 420 properties that they own and manage in the Kansas City market. And so we're going to discuss their affinity for single-family homes, how they find these portfolio opportunities, as well as everything else in between. So without further ado, I'd like to welcome Andrew and Phillip Syrios to the show. Guys, how you doing today?
Good. Thanks for having us, Kevin.
Yeah,
I appreciate it.
Thanks for joining me. And that's a mouthful, man. You guys have been doing a lot of work recently. You've been making a lot of things happen there. So before I'm excited to dive into it and learn more about this recent acquisitions you've had and just learn how you've been able to acquire so many properties in a short period of time. But before we do that, if you wouldn't mind, maybe each of you just take a few minutes and just tell our listeners a little bit more about yourself and how you got into this business.
All right, well, this is Andrew, by the way. I got into the business pretty much right out of college. I was going to the University of Oregon, and my dad got the bright idea to have a real estate investment internship. And so he got a bunch of University of Oregon and some Oregon State students to come in, and we were sending out letters and analyzing properties, and he was bringing in some of his various connections to talk to us about all sorts of things about real estate. And eventually, he brought on a handful of us to go out and look for houses. At this time, we were fixing and flipping. We flipped about 150 houses in Eugene, Salem, and Portland between 2005 and 2011. And so I was involved in that pretty thoroughly, first in Eugene and then Salem, and the market sort of, well, first it crashed, and then it was just, we started to get back kind of making some progress, doing a lot of short sales, when buying from banks and things like that. But then that tightened up and got really hard, and we wanted to get back into buy and hold. And a friend of ours was just kind of almost on a whim going out to Kansas City to look at properties there. He'd been investing around the country, and we just went out with him. And a lot of our extended families in the Kansas, Missouri area. And so kind of just we went out there, we looked at the prices, and we're originally from Oregon, which is California light in terms of prices. It's very hard to get houses and even small multifamilies to cash flow. So we're out in the Midwest, we're looking at the prices and the rents here. The prices are much lower, the rents are lower, but not that much. The rent to cost ratios are much stronger. And it just clicked. Like, this makes sense. Let's come out to Kansas City. So it was just like we were here for a day, and like it just snapped for both my father and I that we need to come out to the Midwest and start investing, getting back into buy and hold, and start investing here. And after we did some analysis of the city and the area, and it made sense, and so we jumped ship about a little over 5 years ago.
Okay, fantastic. And then, Phillip, so you've been doing this for about 5 years, and Andrew, you've been doing it 10. And Phillip, prior to getting into this real estate business, I mean, were you in another line of work, or were you fresh out of college as well? And I don't know both of your ages. I don't know who's older, who's younger. So I asked that question out of ignorance.
Andrew's the older brother.
Okay, gotcha.
He was kind of the trailblazer to come out to Kansas City, and I really only joined him because of the opportunity out here. What happened with me was I went to the University of Oregon just like Andrew did. I was always into business, always into entrepreneurship, always kind of looking for an opportunity. I actually didn't learn a ton about real estate growing up. My dad always had his business, but I was never super involved in it. He'd want to show us houses, and we'd be bored out of our minds. Yeah, I never really learned the business growing up. I actually became a professional poker player during and right after college. So that was what my career path was. I knew it was always a short-term thing, but it made pretty good money for the time. But I was just kind of looking for the first venture to really grab me. And my dad just kind of said, hey, Andrew's doing this real estate thing out in Kansas City. There's an open bedroom. Why don't you go meet him out there? And I was like, no way, I'm never doing that. That's not going to happen. But, by the way, let's stop on this for one second. By open bedroom, that is there's 2 bedrooms in the basement of the office that we yeah. So let's be clear about what we're talking about. In fact, a room with no windows.
The dungeon.
Years. But anyways, after a while talking to my dad about it, my life just kind of made sense to kind of move out here and join him on this venture, and I kind of found my niche within it, and it's been working really well ever since. I'm really glad I came.
Okay. So give me kind of the roadmap of what it looked like. I mean, when you guys first entered into the Kansas City market, I guess, so this question is more prevalent for Andrew to answer. So tell me what it looked like. I mean, so you guys, you literally, you moved out there, you set up shop, but what was the game plan? I mean, what did you start going after? I mean, was it single family homes? Was that your primary goal, was to obtain single family rentals, or were you kind of just looking for opportunities, whatever they might be?
No, our primary goal was not single families, actually. We came out here seeking apartments. We had some friends who were also from Oregon and came out. They actually went out to St. Joseph, and they were buying 90-unit apartments, 100-unit apartments, syndicating them. They take 20, 30, 40% and give the rest to investors. And that model seemed to make a lot of sense to us because of the price points were so much lower. There was a lot of the market was depressed. We thought we could buy them cheap at the time. That being said, we didn't really go about it correctly at first. We bought an apartment here in Kansas City very quickly, which we should not have purchased. We've since got it performing, but it was in a rougher spot than we thought. The tenant base was not nearly as strong. There were a lot of tenants who fell behind very quickly, and then we got a property manager in place who just couldn't keep it going very well. And so we sort of kind of just kept going in that path slowly, finding apartments here, mostly smaller ones, 4-plex, 8-plex types. But it became pretty clear that most of the apartments that we were looking at were too low end, too in rough areas, and we weren't really in position at that time to be making acquisitions of larger 100-unit apartments very often. So we sort of fell into houses. Actually, Phillip was the one who started that process, and you can talk about kind of finding. Basically, what I figured out happening, I kind of came out here, and I was trying to help Andrew find apartments to buy, and I was just getting frustrated because it didn't seem like there was any good ones in any good areas we wanted to, and I just kind of said, it's easier to find 4 good deals on single-family houses to buy than a 4-plex, and if we're buying 4-plexes, why not just pick up these 4 houses instead, because we have to do off-site management anyways, and that's really the only difference. It's not the only difference. It's the major difference between apartment purchasing and single investment family buying is on-site versus off-site property management. I will say that back in, this is 2011, 2012, 2013, here in Kansas City as well as elsewhere, but here in Kansas City for sure, there was a glut of single-family houses in solid neighborhoods. These aren't great areas, but they were there too. They're solid neighborhoods, solid working class, lower middle class neighborhoods, tons of REOs, HUDs, Fannie Mae, Freddie Mac REOs, all over the place, and the price point were just almost absurd. I mean, we were buying like 3-2 splits and ranches for $30,000-$40,000. I mean, they still needed $20,000-$30,000 of rehab, but it was just, I get nostalgic thinking back about those days in terms of price point, because there's just a glut of extremely cheap. I mean, it was not, that was the market at the time, but you knew as soon as these REOs were cleared out, the prices were going to rise, and the rent to cost on those, I mean, they were, you're getting a rent to cost, which is, the monthly rent divided by the total cost in the property of often 2% or more than that, even in pretty quality areas, which is quite rare in our experience. And so that really, as soon as Phillip started pointing that out and looking at some of these properties, it just made sense. A light turned on. It's just.
And we just decided that the off-site management was just going to be a challenge we are going to accept, embrace, and just work to conquer, basically, and be the best in the city at doing that. And it has been a big challenge. It causes a lot of difficulties, but it gives us an opportunity to purchase these as if it's 420 apartment units spread across the city rather than just 420 single-family houses that we have to manage, and it's super challenging. So it's just been a challenge we've decided to embrace and take on.
Okay. And so tell me about these recent acquisitions, because it sounds like initially you started off just buying, maybe you're buying, onesies, twosies, maybe sometimes you're buying, 4 or 5 at a time. But recently you bought 2 larger portfolios, a 41 unit and a 97 unit. Tell me about how those acquisitions came about. I mean, who'd you buy them from? Obviously, the last owner probably is someone that bought them during the downturn in the market. They probably renovated them, got them leased up, and then sold them as a package. So talk to me about the opportunity that you saw and, what excited you about them.
Well, the first 97 property package that we saw came about in a really weird way, and it was really just by networking. Someone wanted to buy one of the houses we had purchased to kind of do a development thing. I just said no thanks, but he was kind of persistent about it, and we got to talking a while, and eventually he was just kind of a commercial broker of sorts, and we just got to talking about what we do and what he does, and he just kind of kept my name in thoughts. And then a month later I get a email from him saying, hey, there's this large package of properties, are you interested in it? And I was about to just throw it in the trash can because I thought it was not any good, because normally when we get large portfolio deals like this, it's a lot of vacant or semi-vacant properties in really bad areas at really cheap price points.
They're on the intersection of Skid Row and Warzone.
Yeah, right. Just really crappy properties banks are trying to push off on somebody who doesn't really know what they're buying. And so, but then I started looking at the addresses, and I was like, these are actually in some nice areas. And so then I threw it to Andrew, and I mean, you kind of said the same thing, saying, oh, I think I saw that one already. No thanks. But then he got to look at it and go, this is totally different than anything we've seen before. And we just thought it was really just through networking and telling somebody what we're in the business for. And he shot me an email just as a second thought, not even thinking we'd buy it. But we were really kind of intimidated by it as well, because it was 97 houses to take on all at once. And I think at that time we had about 200 units or something like that.
Yeah, we had about 200 units, and we were also just purchasing a 32-unit apartment complex. And so, like, we do buy apartments too. It's just not our primary focus. Mm-hmm. And so we had, this was like a huge undertaking. We had to find, I mean, it was priced very competitively. We knew there was a lot of, there was equity there. The seller knew there was equity there. He was selling them as a portfolio and priced them very competitively. But it was, you still got to find a way to finance that, to raise the equity, and then to bring that all, do the due diligence and bring it all under management, which is an extremely intimidating task, a set of tasks to take on. But I think once we realized that this deal had potential, that there was equity there, that there were good properties, that they were well taken care of. We looked at a couple just right off the bat, and like these are kept up really well. Most of the time when I see packages, they are not kept up very well. Yeah. And so it was like, this is something worth pursuing, and that's kind of what led us to really go after it. And I think what was one of the most important things that we did, and one of the things that I would stress the most is we really requested to meet with the seller, not just the listing agent. Mm-hmm. And so we brought the seller into our office, and we talked for over an hour, just about his business, about our business. We showed him, I think, we convinced him that we're a quality operator who can take care of these properties. I mean, he was an older guy who had done all sorts of real estate deals. He'd bought and sold hotels. He had done developments. He had just, like, when he walked into our office the first time, he just got done selling like a $5 million plot of land in Lenexa, Kansas, and it was just
it went on and on. It's crazy.
Yeah, so he had quite a successful career, but he was sort of moving on. He managed them himself. He had like one other office employee.
Oh my gosh!
I don't know how that's even possible, but he found a way. And so I think we built a lot of rapport there, and it was clear that, because we were not the only offer on the table, and we didn't really have the strong offer, because he wanted to sell them cash. He didn't want to deal with, one of the big things for him, we have 97 different properties. He didn't want to have 97 different appraisals.
Oh my gosh.
97 properties. Yeah, it's just that was a really big issue, and finding what's important to the seller is critical.
Yeah, that's what we were able to do. We probably spent 4 or 5 different conversations with him before we were ever able to really even think we were his number one option to buy it. And it was just talking with him about what he wanted, what was important to him, why, we were a good fit for him. We never moved him off of his purchase price an inch, but we knew his purchase price was a good deal to have these properties at. So it was about figuring out the other issues in terms of how do we get this deal done without a bunch of appraisals? How do we, get him his 1031 exchange, which we didn't do, but we found a solution around that to still get the seller what he was aiming for and still get the properties under control ourselves.
I mean, it almost in hindsight, we went with his approach to the point of its absurdity a little bit. At first we did not believe we could do the deal because there's no way we could raise all the money to buy it 100% cash. And so we made a bit of a lower offer, thinking like, well, we'll make an offer that's low enough that we can entice an equity partner even at a good percentage. And so I was going to email the offer. My dad was like, no, do it in person. Do it in person. It's always got to be in person. I'm like, okay, right. So I said, is there a time I can stop by your office and drop off the offer? And then he decided to come, and then I asked that through my agent. My agent said, we'll come over to your office to do it. So I literally presented him our offer with Phillip and me and our agent and his agent and him all there. I mean, it was one of the most awkward things I've ever done to be presenting an offer. It was like almost like a presentation of our offer.
Yeah.
We should have PowerPoint slides and all this nonsense. but it's still, and that didn't work out because he really didn't want to come off his price. He felt, and accurately so, that he priced them very competitively. But by building this rapport and showing him that we were a quality operator, he then turned around. We thought the deal was dead at that point. We couldn't think of any way to raise that money at a percent. Like we could from somebody who would want 95% of the deal or something like that.
Not to interrupt you, because I want you to tell the rest of the story. So to give us an idea of the initial price point, what he was asking, and what your offer was, just so we can kind of follow the storyline.
I believe he was offering $6.5 million for the entire portfolio, which was basically $65,000 a door. And I think our first offer was $5.7 million.
Okay.
Yeah, $5.7 million. So we took it off quite a bit. It was already a good deal at 6.5. We knew it needed to be an amazing deal to entice another partner to come in and leave enough on the table for us, because we could have tried to give up 95% of this deal, but if we're doing all the work, there's no point in ruining other opportunities we might have to do all this work and give away all the equity to someone else.
There needs to be a pot of gold at the end of the rainbow.
Exactly. This deal is a little annoying in some ways, looking back on it, because a lot of it was. It's a lesson in not assuming things, and it's one of those things where every time I was assuming something, my dad would be like, "No, don't do it that way. Do it this way." And you don't like it when your dad is right about everything and you're wrong about everything during this deal. But it pretty much went that. It was like that. It was a humbling experience, but it kind of went like that, because I thought there's no point. We're not going to get it making this offer, but it's something. Don't ever assume anything, because a week or so later goes by, and he calls us up and says, I would consider seller financing. That way, I'd 1031 the down payment.
Right.
But since you don't have to pay, you only have to pay whatever principal you're getting back each month.
Right.
From the loan payment. It's not such a huge tax burden all at once. A lot easier to swallow. So then we met with him again for a couple hours. I put together a large packet of information, like a presentation on our company, why we're strong. Because we were thinking, what if we can get him to finance, 85 to 90% of it. He knows these properties have good. He's given some equity away. So even if he takes them back, it's not that big of a concern, and we're still putting some down. And quite frankly, it doesn't matter that much to him if we're a very strong buyer.
And it doesn't sound like he needs the money either. I mean, from a little bit that you told me about him.
So we gave him this long presentation, and unfortunately, that didn't really lead anywhere. He wasn't willing to budge from 75%. He felt that was fair market. That's what banks would do. That's what he wanted to do.
Mm-hmm.
So again, my dad actually called him after that and talked to him for another 2 hours or whatnot. But it was again seeming like this deal was not going to work out because it was still possible. Well, actually, I just thought we were going through possibilities with regards to raising the 25% down payment, and the best possibility that we had simply wanted too much to make it make sense.
Yeah, they wanted
when you talk about raising money, you're just talking about just putting together like a small syndication to do it, right? I mean, where you give some equity and debt. Yep. So
and the syndication, the people we're talking to are asking for like a 12% preferential return and 50 to 75% of the deal, and
it was gosh.
20. It was an 8-12 pref with 30 30% of the deal, or 50% of the deal with a 12 pref, or 70% of the deal with an 8 pref. So it was a very
it didn't make sense for the time and effort we were going to have to put into it.
Yep.
We didn't want anything to do with something like that.
So now at the same point, our agent had a guy who had actually a family who was selling a commercial property, and they wanted to 1031 that money from the commercial property into something else. So it was like, well, this makes sense. But then he gets back to me like they can't do the trade because the issue was, at least from his understanding, and I'm not an attorney, we're not attorneys, so all of this stuff needs to be discussed with an attorney. It's not legal advice, of course. I'll give our disclosures and all the rest.
Okay.
But the problem, as far as is that it was trading from a property into a syndication, and that it has to be like to like, from my understanding, and from the understanding that we were at least presented. And I'm not. But it just hit me that I remember a friend of mine, that same friend that I mentioned who was in St. Joseph, he was down in Kansas City, had mentioned one time, just called me and said, do you know any properties on the market that might make sense? I've got a guy with a 1031 who's looking to move that money. I didn't know any properties, but that phone conversation was pretty important because it just hit me like, he does syndications. How could he do a 1031? So I called him up, and it's like, don't do a syndication, do a TIC. Because if you're doing it, the difference between a TIC, I'm sure many of your listeners know, but the difference, it's sort of like a syndication is like a bowl of soup, and so you own half of the soup, but what half is yours, who knows? And a syndication, or in a TIC, is like a loaf of bread. You cut it right in half, or whatever percentage you own. And so that way it is like to like. They are owning half of these properties, not part of a partnership.
Mm-hmm.
And so we met with them several times and built some rapport with them, and then it just kind of kept going from there.
Yeah, and then eventually, we were able to do some due diligence on the property, close it, and then that was the whole challenge of itself, taking on 97 properties managed. And that was one thing that was good for us, is if we weren't doing these onesie-twosies and building this management company and taking on the burden of off-site property management, there's no way we could have taken on 97 properties, built the management structure all at once, and been confident in our ability to manage it well and effectively, because it's a lot to do, and if we weren't already feeling like we were doing it well, there's no way we could have taken on 97 all at once if we didn't already have a structure in place.
Yeah, that'd be overwhelming. So that actually, I don't know, maybe you guys already addressed it. So do you actually have your own management infrastructure in place, or do you have a third-party manager that you deal with for all your properties?
We have our own management company out here in Kansas City. It's called 333 Rent. I'm the head property manager. That's basically my role in the partnership between my brother and my father and I. We manage basically every single property that we own, and that's, I think, been a huge part of our success here. And with single-family houses, I think that's one of the big things you have to do. You have to be really in the trenches of the management, because so much can go wrong with managing off-site and managing single-family houses.
Yeah, absolutely.
One bad tenant we've had tenants before do $10,000 worth of damage, so the screening is critical, and luckily, and we knew this going in, that the seller had did a good job and he had good management. But even the due diligence on that was challenging because one of the big things is he didn't want 97 appraisals. So, we had to have a private loan, got around that issue, but we also had to find a way to do our due diligence.
Yeah, how about 97 inspections? I mean, that's pretty overwhelming as well.
So that was just kind of off the table. So how do we do it? Well, what we did was we made an agreement. I would drive by every property. And then I'd also, because I'm a big proponent of walk every unit, every single one.
Yeah.
Unless there's, for some reason, you just can't do it to get the deal done, which was this case. One of the big things, we knew this was a great deal. One of the things the seller was big on was not having an inspection of every unit. So we agreed to walk every turnover that was going on during the due diligence period. He would show us the worst properties that he had, the 2 worst that he considered. And then we picked, I think it was 6 or 7 at random, just throwing darts at the data tape, and we looked at those properties as well. So we got a good flavor of what was going on. But even in that sense, I feel like we probably, if there was one thing we missed out, there was a bit more deferred maintenance than we anticipated.
The biggest problem, though, with us is we didn't know what we were going to find to make us not want to do the deal because we knew there was equity there. So even if we found a lot of deferred maintenance, a lot of problems with the properties, even properties that needed $10,000, $15,000 worth of work, we knew the equity was there regardless. So we weren't going to ask for a big concession going into the deal because we knew the deal made sense even if there was big deferred maintenance going on because there was a big equity position there at the same time.
Which there wasn't huge deferred maintenance, but there was a bit more than we anticipated, which is just more proof that walking every unit, if you can, is something you need to do.
Mm-hmm. Yeah, it's funny. We're in contract doing a deal. It's a mobile home park, but it actually comes with about 45 or 46 units that are owned by the park, and which isn't a preference of ours. Typically, if we buy a mobile home park, we try to have it to where we're not buying a lot of rental units because it's just not a really good part of the business model. But in any event, this one, it's kind of an anomaly, and it's got 46 units that are coming along with the sale, and but they're all newer. They were all only I think about 12 years old. Nice models, and the park's only like 16 years old, which is a really new park. I mean, because they literally you don't see many parks that were built in the last 20, 30, 40 years. I mean, most of them were built way back when. But in any event, the seller he was really adamant about not allowing us to do a walkthrough in these units. And I had driven through the park multiple times. And the exterior of the park, they've done a really bad job. They had a storm that went through there a couple years ago, like a windstorm, and it ripped off a lot of the underpinning of the trailers. And the grass was kind of like not being kept up. And it just looked like crap. And I'm like, in my mind, okay, these units are only 12, 13 years old. But if they take care of if the quality of tenants that they put on the inside is anything of a reflection of what it looks like on the outside, then I am absolutely going through every unit because it's a really good deal. I mean, we got structured really good owner financing terms. It's a home run. But if we're going to run into a situation where we turn like 30% of the units right away, and then each one of those units needs $5,000 to $8,000 worth of renovations to get it ready again, then it's not so exciting of a deal, So like he pushed back pretty hard. He was going to allow us to go through, I believe 8 or 10. And I just went back and said, look, it's really is a deal killer for us. Like I want to go through all of them. I know it's a pain in the butt. You got to let all your residents know, but we got to get through all of them. And he allowed us to do it. And I was pleasantly surprised. If I would have put my money on the table, I would have lost because I was betting. I went into that process thinking that we were just going to back out of this deal because I literally went in thinking, who the heck? I can't believe they can even rent these things. They were like 100% occupied. And I can't believe they could even rent them with they look like crap on the outside. But I went on the inside, completely different story. They were really nice. There was a few that were like a little bad. I mean, there was a few that the people live like pigs. But I mean, 85% of them were in really good shape. And I was just I was pleasantly surprised. But I'm glad I did it because I would have been questioning all the way to closing. I'd had some resentment building up inside me, like, why are we doing this? Why are we doing this? I know that we're going to run into this big surprise when we close on this thing. We're going to get some units back, and they're going to be ugly on the inside and need a lot of work. But now I'm comfortable. Like I'm glad he allowed us to do that, because now I'm comfortable and I'm real excited about it. Which it sucks when you're not overly excited about doing a deal, right? I mean, when you're kind of questioning whether or not you should move forward. And so, but yeah, he was adamant about it. But I'm always pretty adamant about going through units, because I've been surprised in the negative manner before when I didn't actually do a walkthrough. So I've actually lost money on a few deals in the past where we didn't do a walkthrough of all the units, and either there was like phantom tenants there, or just the unit was stripped, like wiring stripped out of the wall, and just things like that just cost a lot of money. And but sometimes you gotta give in, right? I mean, everyone's got to give in a negotiation, and it sounds like you guys gave in a little bit, but you knew in your heart of hearts that there was still enough spread there. There was enough meat in the bone that even if it was a little worse than what you anticipated, then you'd be all right. I mean, it would still be a great deal for you.
Yeah, even if it was a lot worse, we were still going to be excited. We didn't know what we were going to find that was going to make us back out. The 41 properties that we bought I feel like it was very similar to what you were talking about in terms of the outsides of them really did not look very good. We were kind of skeptical about the whole situation. But once we did our due diligence, we thought, okay, there's a lot of work here, but we can make this work. But those ones would have never done the same thing because the equity wasn't there if they were trash.
Yeah.
I mean, we backed out of a 70-unit apartment complex a couple of years ago because the condition of the units wasn't nearly as good as we anticipated it was when we got it under contract, and so it's absolutely something that I think is critical. And this one is an aberration. I think that it really only made sense to forgo on doing all the walkthroughs because one, it was a critical issue for the seller, and because we knew even if they were in much worse shape than we thought, it was still a good deal. And I think given we drove by all of them and we went through about 20% of them. I think we got a good enough flavor to understand this is a good portfolio for us.
Mm-hmm. So tell me about the final term. So you guys, you got them to finance it. You found a partner. You did a TIC. Tell me about how that structure looked. I mean, did you guys did you raise all the capital for the down payment and then just split the deal 50-50 since obviously you brought it to the table, or what did the equity split look like? And is there any there's no preferred returns paid in a TIC, right? I mean, it's just equal ownership, equal cash flow. So what did the final terms look like then?
Well, we split it 50-50. We brought about 10% of the money to the table, and they brought 90% of the money to the table, which was just about exactly what they needed to 1031. So it was a great deal for us, and it made a lot of sense for them. And so I think it's going to work for them great too, because it's got a lot of great cash flow potential, and we've been raising rents on it, and we've got a bit more deferred maintenance than we anticipated, but at the same time, we've been raising rents a lot on these, especially probably about half the portfolio are in areas that we're raising a lot, or maybe more.
I'd say about 60 to 70% of the portfolio is getting their rents raised 20 to 40%, which is pretty great.
Upon each turnover.
Yeah, once we move out. The turnovers are being more expensive than we originally thought. But yeah, it was a 50-50 split, no preferential return, and there's like a 8% management fee, I believe, for us doing all the management of the portfolio. It's pretty simple. I mean, we had one partner, really. It's a group of a family, but it was just one partner, which made it a lot easier than having to string together, 10 or 15 people or whatever you do with a big syndication type of deal. So that made it a lot simpler.
Yep. Okay. Well, good deal. Now, what kind of projected returns, did you guys pitch to these to this one investor, and have you guys been able to hit your targets?
We were pitching approximately. It was about 7%, and then it goes up if we were to do a buyout, which is part of it, in 5 years. But right now we're a little bit below that, but I think we're going to actually exceed it as soon as we get through some of these turnovers because of the rent increases. Yeah. The increased deferred maintenance has lowered our return some, but our income is well over our projections. So the current numbers aren't quite as good as we'd like, but in the long term, I think we're going to be able to beat our projected return. Okay, so you've been funding that deferred maintenance out of the cash flow of that portfolio, which is why it's affecting the cash on cash. Okay, yeah, and that's another issue. And, I was going to bring that up, and that's one of the big issues when you're buying an apartment building or a portfolio like this, and you can't do walkthroughs because typically, if you're going to do a capital raise, then you're going to
you're going to go ahead and raise enough capital to handle any of that deferred maintenance. You're going to raise that up front because it's going to be something that's going to come up in the first 6 months of the operations. So you're going to go ahead and just plan for it ahead of time. But if you can't, and that's actually a big challenge I see a lot of new investors go through, is that they get into a deal and they go in underfunded. They don't really know what that even means until they're in it, right? And they say, well, you know what, it's okay. We'll do these things out of cash flow. But there's a problem with that, and that. Not you guys. It sounds like you guys are doing great in this deal, but those that get into something thinking that I've got just enough money to get into the deal, and then I just won't take any money out of it for 2 years. I'll just put all the money back into the deal and make this a beautiful property. Well, what happens is there's some resentment that starts building in you as a person because it takes energy, it takes time, it takes focus to manage a property. Let's say it was a 50-unit apartment building and you literally were putting every ounce of cash flow back into it to fix the items that you should have actually you should have raised capital for in the beginning, or you should have found a partner or whatever it might have been. You should have projected that in the beginning. And it starts not being an enjoyable business when you can't take money for your efforts.
Yeah, this portfolio is at 93% occupancy when we purchased it.
Yep.
But the next portfolio, the one at 41, sums that up perfectly.
Oh gosh.
Yeah. I mean, taking the deferred maintenance and having smaller returns has been very painful, I think.
Yeah.
But I'm extremely optimistic about the overall performance of the portfolio, just because we had a house that once it went vacant, we had to put I think $3,000 or $4,000 into it, which is quite a bit of money, but we raised the rent by 70%.
Wow.
So when you're able to do something like that, it's gonna hurt that month's return, or when you have to put all this money back in these properties. But when you have that 70% increase in revenue over 4, 5, 6, 7 years, it just starts to create an avalanche that we're expecting. We've only had this portfolio for about a year, so in years 2, 3, 4, 5, we think it's really going to start kind of snowballing into something really big. So we're excited for that. It's been a lot of work, and it's going to continue to be a lot of work, but we knew that getting into it. That's why we weren't going to take a deal that didn't make any sense for us.
Mm-hmm. So are you guys still in like an acquisition path of terror where you're just like buying a ton still, or have you slowed down a little bit? Because every market's local, and I don't know the Kansas City market at all. But are you guys still finding opportunities out there? I know these acquisitions were somewhat recent, but tell me about your recent activity. Is there plenty of deals coming down the pike?
Well, I would put it this way. We were thinking that after we purchased this 97 package of 97, which is just after we purchased the 32-unit apartment complex, we need to slow down. And then the 41 hit us. and so we are constantly, we've been thinking like we need to absorb this more, but we do continue to find deals. There's this constant feeling I have like it's over, like the party's done. There's no more deals to be had. But then we'll find a couple here or there. It looks like we're about to buy a really small package of 5 properties. So, and which when we had just before that, I think we had nothing under contract, and now we have 4 houses under contract, and that package of 5 will likely get. So, it's been slowing down. I would say we're really our main focus is to absorb. We've doubled in size over the past year. We went from 200 units to 400 units. And we're on a higher, and this just happened to be actually, like in February of last year, we let go of about half of our office staff, and then in July we purchased 32-unit apartments. September we purchased the 97 units, and then in March and April this year we purchased the 41. So most of our focus is on hiring, absorption, rehab, things like that. But we are still looking for new properties. We are we've always been an opportunity-based investment company. We invest when there's an opportunity. We came out looking for apartment communities. We didn't see an opportunity there once we were here, and we really were frustrated, so we moved towards the opportunity of single-family houses that we found. And that's the same thing where it's now. As soon as there's an opportunity for us that we think makes a lot of sense, we have the ability, we have the team around us to make work. We're going to jump on it because we always feel like we'd rather jump on a high equity position that we can take on and then suffer with the extra workload and maybe the more difficulties in management, because we're going to lock in that equity while we can, and we're going to deal with the management headaches
as we keep moving forward. So just a while ago, we were looking at a big commercial portfolio. Because it was an opportunity that was put on our desk, we ultimately weren't able to make it work, but it's what opportunities we find in the marketplace we're going to pursue, and if we find a way to make it work, we're going to jump on it, no matter what our position is. As long as our position keeps it an opportunity. If we found, 100,000 rental units in Milwaukee, we're not going to buy it even if it has a great equity position, because we have no ability to take that on. So as long as it's an opportunity we feel like we can take advantage of, we're going to jump on it.
I mean, if it had an embarrassing equity position, we'd take it.
Well,
That's awesome. And what are you guys doing to find your deals? I mean, do you do a lot of direct marketing? I mean, are you doing direct mail campaigns, or most of the things that you're buying just off the MLS or through networking?
The majority of them are actually off the MLS.
Isn't that amazing? That blows my mind that happens.
When I was in Oregon, there was no way we could do it. We never bought anything off the MLS. And so it was all direct marketing. But when we got out here to Kansas City, there's so many REOs at such good price points that it's just not as competitive. It's not as tight a market as it is on the coast. And you can find a lot of, they slip through even now. I mean, we've got every month there'll be a couple properties that just are mislisted, particularly by like HUD and Fannie. They tend to mislist properties a lot. And often there'll be a bidding war once it comes open to investors, but still it's usually tight enough that we can get a good solid equity margin. And we make, we're looking at dozens of properties every month on the MLS, and we're making offers on most of them, and we're getting only a couple. We also network. We also troll Craigslist. We network with every wholesaler we can find, and we have been doing direct marketing lately. We've done a little bit at the courthouse steps, but we kind of backed off of that just because we backed off it at the time because we didn't need any more inventory. We're getting all the inventory we could handle. And also, the courthouse steps always tend to have that guy who we call him Voldemort, who just buys everything, bids it up above market value.
Yep.
And so it's a little tricky to do that unless you plan on just like dominating it, which has not been necessary for us, and it's probably going to be difficult to get into. But most of our onesie-twosie acquisitions have been from the MLS networking or things like that, although we do some direct marketing.
Okay. And so what does the end game look like for you guys? I mean, you're young, so what are you guys both close to 30? Are you in your 30s? I guess, Andrew, you're probably 31, 32-ish, something like that?
32.
Okay.
Andrew's 32, I'm 29, so
okay. Okay. So what's the end game for you guys? You guys are super young, super successful, absolutely kicking butt. I mean, do you guys have like kind of a goal of the number of units that you'd like to hit by, 2020? We want to be at 1,000 units. I mean, do you guys actually have a target like that, or are you just going to keep buying until you get tired and fall over?
I mean, finding a goal is, my original goal is like 100, and now we've kind of blown past that. So it's kind of like, what is the next goal? I mean, we want to continue expanding. I think for me, it's more of a short-term goal right now, is to get our office, our property management, our rehab systems to the point where Phillip and I can step out of it. Not like be done with the company, but where we are not in the everyday thing. I'm not like right now. I don't deal with looking at MLS properties. We send out our agent. He puts together a list. And I only go look at it if we're really close or we got it under contract. And I want to do the same with rehab. Phillip wants to do the same with turnover. So we can move to the point where we're doing more oversight.
Yep.
Instead of that's the immediate goal. It's sort of like a long-term goal. Do we want to get to 1,000 units? Yeah, I think so.
Okay. And then, do you guys see at some point in time you exit out of everything, or is this a long-term play where you're just holding for cash flow?
We're just holding for cash flow. We're buy and hold investors. We see the benefits of that. It's a long-term play. I think there's too much. I think there's a really big transactional cost in buying stuff like this and then trying to unload it once the market shifts. I really like the idea of acquiring, building up a foundation for a company, and just increasing that foundation as we go. I think I'd add to that, most of the loans that we're getting, just based on our market and the fact that single-family investment properties, which banks tend to be a little shy about, it's mostly local banks. They're giving us mostly 20-year AMs. We're getting, it's like 5% 20-year AMs.
Really? So, on the single-family homes, you're getting 20-year AMs? That's it?
Yeah, but the thing is, it's a little tough, but they still cash flow really well out here in the Midwest on that. And in some ways, I'm not really that opposed to it since they cash flow well. the principal pay down, the principal just the pay down starts to accelerate quite quickly.
Absolutely.
And so you get the appreciation going. The principal pay down starts off. It doesn't even start off that slowly when you're at 20 grand. 30 years it starts off like a crawl, but 20 years it starts off decent, and it just accelerates. And getting towards the end of that getting to the 10th, 11th, 12th year, that's really kind of. That's an exciting. Looking at the numbers as we get there becomes pretty exciting.
Mm-hmm. Now, is the goal with like your overall portfolio? I mean, do you guys is your end goal to actually own things free and clear? I mean, or do you guys say I'm of the mindset that we have a couple properties that in a couple of years we will be free and clear if we just kept paying them down, but there's a certain point to where it makes sense to have leverage, especially when it comes to a refi, and you can pull some money out that is tax free for the time being. Like we're buy and hold investors, we hold long term, and so we really never intend to sell, and we do 1031 exchanges. We'll buy up into other properties, but we really just like to kick the can down the road. But so very few times does it make sense for us to actually have zero leverage on a property, because essentially we are pulling the money out tax free. We'll never over leverage it. We'll if we ever bought something down, or if we paid something down to zero, maybe we go get a 30 or 40% loan on it to where it's still very low leverage, but yet get that cash out and keep it in use. Put it into another project.
Well, to answer your question, I think I can just speak about what my dad's done. He's been investing in real estate heavily since 1989. I don't think he purposely has ever owned anything free and clear before. So he's definitely had time to pay down those mortgages, but has chosen not to. So he always refinances. And I mean, the thing is, that if you have a free and clear property, you really just have money available in that you could use to pay down your higher interest debt, or to invest in another property that can give you a higher return. So there's a really big opportunity cost by having something free and clear. So we don't really necessarily, we just intend to use our equity and funds as wise as we can. If we find opportunities, we'll pull out cash to go face those opportunities, and if not, we'll just keep paying down that principal and see where we go from there. We don't have an exact plan, but we like to use debt to expand our company. Okay,
well, you guys are doing awesome, so just keep doing what you're doing. I'm going to ask you a tough question now, and it's I don't know how tough it is, but and you guys have been at this now, Phillip 5 years, Andrew 10 years, but you guys have done a lot in that short period of time, and so knowing what you know today, you guys have 420 plus properties underneath your belts. If you can go back to year one when you were both getting started and give yourself some advice, what would that advice be? And each of you can answer this individually, because you probably both have different answers.
I mean, my direct advice would have been to come out here 2 years earlier, or maybe even 3 years earlier, and focus on houses immediately. Now, it's not really fair, but I think in hindsight, that would have been definitely the best thing for us to do. But I think that would be the first piece of advice I gave.
For myself, again, I focus on the management side. That's what I do day in and day out. And I think the management part is often the most overlooked part of real estate, just basically because I do it every day. I'm probably biased towards that. But what I would say is, no matter how much you put in effort into management and managing your tenant base, you're never going to really be able to change the person who moves in the first place. So 95% of property management is attracting the right residents, screening out the wrong residents, and keeping the right residents and moving out the bad ones. That is 95% of the job, because after you do that part of it, you really can only work on the margins. So if I was going to give myself one piece of advice, it would have just been completely focused on the tenant base, keeping it high quality, doing everything you can to attract high quality residents. And that is by far the one thing that has made our management work compared to when it was not working as well as it is now. That is by far the most important thing.
That's great advice. Give me some real quick, and we're running out of time here, but I want you to give me some quick bullet points of what that looks like. Give me like the top 5 things you guys do to to find the good tenants and weed out the bad ones. I mean, in terms of like household income, credit, credit history, not necessarily credit score, but credit history. Yeah. I mean, tell me about what those bullet points are.
Well, the first thing we do is we try to rent on the higher end of the market, even in bad areas of town that people don't typically want to live in. We like to have the nicest property at the highest rental point for what that property is. So we have some cheap rentals, but they're higher than the stuff around it because we make them nicer. Because even if there's not a lot of great renters in that area, we want that one great renter to want our place because it's the best one there. So we typically fix our properties up nicer. we rent them out for a slightly higher amount of money, and that way we attract the higher end renters for that neighborhood. That's the first thing we do first and foremost. After that, we check very strictly for evictions and felonies. It's basically none of either. Technically, it's none in the last 10 years, but even after that, our rules are pretty strict. You have to have a year of rental history, or mortgage history can count as well. You have to have a pretty good credit score. The credit is kind of hard to define because we look at a lot of different things like negative and positive trades and collections and things like that. It gets kind of complicated, but basically you want someone who has a history of paying really well on their debts. And if they have a lot of collections and things like that, it means they've broken agreements in the past, so why are they going to hold on to your agreement?
Yep.
And it's just making sure they have steady income, that they've had it for over a year, that they're making enough money to live in your property, that they're not transferring a job from elsewhere and have no confirmed payment for the next year, that they're just thinking they're going to figure it out, because if they don't figure out, you're the one on the hook. So those are the big things we look for. Nothing that non-standard. We're just really strict about the things we do look at, and we rent on the higher end of the neighborhoods we're in because we want the best renter in that neighborhood.
Yep. I always tell people it's better to have an empty unit than to have a rented unit with a bad tenant in it.
We just got a deposit on a house, I believe it was today, and it was the 16th application that came in because we denied 15 people before we approved this person. So we are very strict.
Wow.
We do not make concessions about it. It's not in the greatest area of town, but again, we were going to wait until we found that person that made sense for this unit, and we finally did. So we feel like that's going to pay off in the long run because we're not going to have to evict someone and turn the property over again.
So when you say that you actually denied 16 applications, like they actually filled out the application, paid the application fee, and then you guys ran the background and credit, and then obviously something popped up. Now, with that being said, I'm assuming that you're probably pretty adamant about telling them ahead of time. Like we always do this. Like I don't want to waste anyone's $30 or for their application. So like, look, here's our basic criteria. If you have this, that, or the other, like don't waste your time because you're not going to qualify. And so have all 16 of these people, like they kind of knew what the qualifications were and they still applied anyway, just like crossing their fingers that they were going to make it? Or
that is correct.
Yeah.
We pre-screen all of our residents. I could pull up the numbers, but we've done a ton of showings at this property. It's been really frustrating for my leasing agent. I have a great sales team, but they've obviously gotten frustrated by this, but we are going to wait until and they understand because they don't want to have to rent it again in 6 months when we evict the wrong person. So you just have to be really dedicated to that idea and not make any concessions about it and just say this is what our standard is, and if we can't do it, I'd rather put more money into the property and make it nicer or rent it for less than make any concessions on our actual qualifications.
You can't be a softie in the property management business. You just can't.
Exactly.
And if you're prone to be that soft guy and listen to someone's story and feel bad because they went through a hard time, then take yourself out of that position and go do something else in the company because it just really has to be set in stone. I mean, I will. There are times I will listen to a story if I can't. 99% of the times I can put the story together when I look at their background, their credit. I can actually tell you what that person did, what they've done throughout their life, how they've been with bill payers and things of that nature. I mean, it doesn't lie. And so when you read through their story, you put together a story of them and you see that they've neglected to pay a lot of their creditors in the past. They might have a few good trade lines, but majority are bad trade lines, negative trade lines. They've got excuses because, I got a divorce or this or that happened. And I understand everyone's got circumstances in their life, but it doesn't lend for the right to not pay somebody. And so
I'm sure they'll have a good excuse when they stop paying you.
Absolutely. No, you're absolutely right. So, and you just can't be a softie. And that's actually one thing that I feel like I'm really good at just not being a hard ass about it, but it's like, it's black and white. I mean, there's really no in between. It's just either you qualify with our basic qualifications, whether it be, a certain amount of household income, positive trade lines, no evictions. We do 10 years, no felonies, all that kind of stuff. And I don't necessarily even need to hear your story. It's just, it is what it is. And I don't want you to waste your money. You might be better off going somewhere else. If you think you have any of those, or you think you don't qualify for any one of those things I just mentioned, just go down the road. You could probably find somewhere else that will, be more than happy to let you in, but it's just not going to work here. And,
absolutely.
But and then the funniest part is when you get guys that say, "No, I've never had no criminal past," and they got like a 10-page rap sheet. Well, how about this? How about these cocaine charges from North Carolina? Oh, I forgot about that. That was 8 years ago. Oh, really? Okay. So anyway, well, guys, one last segment here before we get going. I apologize, we've gone over time a little bit, but we're entering now into what I like to call the Golden Nugget segment. And this is where I like to ask each one of you if you could leave one last final golden nugget of advice or wisdom that may inspire and motivate our listeners as they progress in their real estate investing career. What would that one last golden nugget be?
I would say whenever possible, meet with the seller. Meet with the seller directly. I mean, if you're doing volume offers like we do on these MLS properties, it doesn't matter at that point. But if you're doing larger transactions, or if you're trying to get into single family, you're a new investor, you're just trying to buy that one or two, always, whenever possible, meet with the seller, build rapport, learn what they actually want, because it might not be what you think they want. Don't assume anything. But if you can get in front of the seller, or at least get them on the phone, that is immensely helpful for getting a deal done.
Mm-hmm. No, that's absolutely truth. And, I'm going to expand that real quick, and then I promise I'll let you guys go because I know you're busy guys, and I promise I wouldn't keep on the phone for more than an hour. But with that being said, there's something that we've noticed in our business that goes along with meeting these sellers in person. And now all the deals that we've bought over the past couple of years, none of them have been for sale. Everything is off market. We go direct to owners. And a lot of times it's a long process to get to a closing table. But we found a strategy that's been working really, really well for us lately. And a lot of these properties that we find, we do direct mail, we cold call, we do everything. In fact, we haven't bought anything through a broker in the past couple of years. So everything's been direct marketing. But what we started doing recently is every time we do get a property under contract, once we're at the point in time where we're going to go actually on site, and most of our properties are out of state, we'll go on site, spend a day or two in the area doing due diligence on the property itself. Before we go there, we put together a list of all the properties that meet our criteria within like a 50-mile radius. And they've already received letters from us. They've already gotten cold calls. But if they haven't responded over the past year or two that we've been actually prospecting to them, we'll send them one last letter and we'll make a phone call to them about a week before we're actually heading to do due diligence on the property that we have under contract. And we'll say, hey, we're going to be in town. We'd love to meet with you. Maybe now is not the time for you to sell, but we'd love to meet in person. We're going to be in your market. We're going to be in the same, same asset class. It's just good to know others in the business. And you would be blown away by how effective that strategy is. I mean, we just got back from Alabama on a park that we have under contract, and we had 4 meetings while we were there in 2 days. I mean, 4 meetings that we did not have lined up, 2 weeks prior to us going. And we sent this letter out, did a couple calls, and got 4 meetings lined up with property owners. And one of those, I'm pretty confident we're probably going to be able to buy. And that guy never responded to any of our other solicitations. Direct mail, cold calling, nothing. But that letter he did. But it's because he knew we were coming in person. He's a mom and pop. He's owned the property for 30 years. He's got some emotional attachments to it. His father built it, and he just wanted to meet the people that might be taking it over. And he also wants to know that we're kind of ingrained in that local marketplace. And so in person goes a long way. It's really hard to get to know somebody over the phone. It's really hard to get to know somebody via email. And email is the worst. Some people are really bad about communicating their emotions in emails, and they come out completely the opposite way they hope for them to. And so it's always good to get in person when you can, and it's a very effective strategy. So
that's a good little side point. With regards to emails, you should make them almost a little awkward in how nice and pleasant they are, because they will probably come off more hostile than you anticipate. I always end my emails with thanks, no matter what. And so that's a good little side point. We'll add that as the golden nugget asterisk.
All right, good deal. Well, guys, this has been a lot of fun. I'm glad we had the opportunity to get on the phone together. You guys are just, again, you're going gangbusters there. You're having great success, and I really wish you the best. It sounds like you don't need my wishes, but I'm going to give them to you anyway. So
appreciate it. We need all the help we can get.
For those that are listening in, if you'd like to go learn more about Andrew and Phillip and their company, you can go visit them at stewardshipproperties.com. Again, stewardshipproperties.com. And guys, that's all we have for today. We really appreciate it. You take care and have a wonderful week.
Thank you. We appreciate it, Kevin.
Thanks, Kevin.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.